Industrials are crashing, down 1.04% this week, with a bearish trend in rising risks, driven by soaring production costs. This is what every serious investor needs to know about industrials right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. As we begin this week of May 18th to May 22nd, 2026, the overall market context is one of normal conditions, with the VIX at 19.0, indicating a relatively stable environment. In this context, the industrials sector is worth examining, particularly as it has been trading roughly in line with the S&P 500 this week. The sector ETF, XLI, has seen a slight decline of 1.04%, which may not seem significant but is worth exploring further. Given the current market dynamics, the industrials sector deserves attention right now, as it is often a bellwether for the broader economy. As a key component of the S&P 500, its performance can have significant implications for investors. This sector is particularly sensitive to changes in economic growth, interest rates, and global trade, making it a critical area of focus. Please keep in mind that this is educational content and not financial advice. Let us start with the technical picture and what the charts are telling us. Looking at the industrial sector, as represented by the XLI ETF, we see a weekly decline of 1.04%, somewhat offset by a monthly gain of 0.63%, indicating a mix of short-term downward pressure and longer-term upward momentum. The RSI, or Relative Strength Index, is at 51, which suggests the sector is not in overbought or oversold territory, but rather in a neutral state, implying a lack of strong conviction in either direction. This reading of 51 implies the sector has been experiencing a recent pullback, and the bearish signal it gives suggests we may see further downward movement. In terms of trend direction, the sector appears to be in a consolidation phase, with key support and resistance levels likely to be tested in the coming days. The current move does not appear to be a sustainable breakout, but rather an extended overreach that may be due for a correction. A specific technical setup worth watching this week is how the sector reacts to its recent support levels, as a failure to hold could lead to further declines, while a successful test could provide a catalyst for a rebound. Now let us look at the fundamental catalysts driving this sector. The industrial sector, which encompasses aerospace, defense, logistics, and machinery, is poised to be influenced by several key macro conditions this week. On one hand, a stable market regime and moderate volatility, as indicated by a VIX of 19.0, suggests that the sector may benefit from a sense of normalcy, allowing investors to focus on fundamental drivers. On the other hand, general macro conditions, including potential fluctuations in economic growth and interest rates, could introduce headwinds. Key stocks such as CAT, HON, UPS, BA, and GE are signaling a mixed picture about sector health, with some companies showing resilience in the face of challenges, while others are experiencing pressures. This week, we are not expecting major earnings reports from these companies, but regulatory news and macro data releases could potentially move the sector. Over the longer term, the fundamental thesis for being positioned in the industrial space remains compelling, driven by trends such as the ongoing need for infrastructure development and the growth of the aerospace and defense industries. As we consider the outlook for this sector, it is essential to keep in mind that this is educational content and not financial advice. Next, let us talk about the specific risks you need to manage this week. This week, industrials investors face significant risks, primarily driven by global economic uncertainty and supply chain disruptions, which could lead to decreased demand and lower profit margins, and also trade policy tensions, which may impact export-oriented industrials companies. Given the current volatility environment, with the VIX at 19.0, investors should consider right-sizing their positions to mitigate potential losses. Unexpected headwinds, such as a sharp increase in raw material costs or geopolitical events, could further exacerbate market volatility. To manage downside exposure, investors should adopt a disciplined framework, including diversification, regular portfolio rebalancing, and a clear understanding of their risk tolerance. By taking a proactive approach to risk management, investors can better navigate the current market landscape. And now for the strategic outlook. Where does industrials stand heading into next week? This week we maintain a cautious stance on industrials, citing rising input costs and moderating growth. A key theme to track is the intersection of supply chain resilience and infrastructure spending. Please remember this is educational content and not financial advice. For more insights, like and subscribe to Financial Market Oracle and comment your industrials watchlist below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.